Welcome back, everyone. We're here with Your Money Matters. I am your host, Angela Giroux, and joining me, as always, are Ted Bauman and Clint Lee. Now, one word I'd hope we could lay to rest for 2020 was unprecedented, and here we are, 2021, not even a month into it, and we are dealing with quite the unprecedented situation. Now, just to let you all know, Ted did put together a presentation very recently on his profit switch strategy. And you should know this is the strategy that uncovered 10 out of 12 winners last time we were dealing with something unprecedented in 3 months in 2020 when the Dow shed 5,000 points. So I think it's very timely to take a look at it now. There's a link above and below. But moving on to 2021. Gentlemen, it's been quite a week, huh? We have a lot to unpack. We're going to try to get through it quickly, but we're going to look at 4 points today, if you don't mind. I want to know, was what Wall Street Bets did illegal? Is it a threat to market liquidity? Are we likely to see new rules and regulations come out of this? And of course, most importantly, what can investors do right now to protect themselves and or get ahead? So Ted, let's start with that first question, and I'd like to point it at you.
Sure.
Was what they did illegal?
Oh, well, we'll come to that in a second, but I just want to point out in my video that I recorded for Friday for YouTube, I speculated on some of the stuff that might have been going in the background with Robinhood, and it turns out that Robinhood was actually it suspended trading on GameStop because of margin requirements from its own clearinghouse, not because of manipulation from hedge funds, although I still suspect that that might have had something to do with it. So I just wanted to throw that out there as a correction. The second thing is on the question of illegality. Look, the SEC says that to be illegal, market manipulation means you have to have the ability to manipulate prices, that you intended to manipulate prices in a way that does not reflect supply and demand, whatever that means. That you caused artificial prices and that led to some benefit for you. Now, in the case of Wall Street Bets, clearly they had the ability to influence prices. There's no doubt about that. They affected supply and demand. The question is, did they affect it in a way that doesn't reflect the fundamentals of the company, but just reflects the supply and demand for the stock? Absolutely, they did that. They caused artificial prices, and a lot of people benefited. But the question of whether it's illegal or not depends on whether they were doing it specifically because they wanted to make money. If you read Wall Street Bets, they say they did it for fun. Is that illegal? I don't know. I think it's gonna cause a huge debate that's going to go on for a long time. There are going to be papers written about it. We'll talk in a minute about what regulation is likely to come out of it. But I think this has demonstrated that in the internet age, rules that were written back, when people were trading by picking up the telephone and calling a broker, not working anymore.
No.
So we don't know whether it's illegal. Time will tell.
All right.
I just want to add to that real quick, because I hate wading into this debate of whether this was illegal or not with the Reddit boards and Wall Street Bets. I haven't read through everything, but I want to go back to one thing, Ted, you'd mentioned about their impact on supply and demand. I really don't think, I think what they saw was an opportunity to exploit something like an inefficiency that was in the market. So I think it's more, it comes back to sort of this question of market structure that allowed them, I don't think they manipulated supply and demand. I think it took advantage of supply and demand, because over 100% of GameStop's float was sold short. By one estimate I read, someone said that the shares had been borrowed and lent out like over 2 times by hedge funds and others wanting to short the stock. And so that created this situation where all you needed was a little bit of demand coming in to the share price to start to have that cascade effect, that snowball effect of sending shares higher as all the shorts need to rush in to cover their positions. So I think a lot of this ultimately comes down to market structure, actually, and how is it that you can have this many shares as a percent of the shares that are out there sold short.
Well, it's arbitrage, isn't it? And arbitrage is supposed to be part of the price discovery mechanism. So the fact that it burned a lot of big people, that doesn't make it any less arbitrage. So I think Clint is right.
All right, so let's move on to the next question then. Is this a threat to liquidity? And then if so, where would it come from? Ted, let's start with you.
Well, I think we've already seen that happening. I mean, there's been a reluctance to push prices up across the board for the last 2 days. Stocks that have absolutely nothing to do with this have been kind of inching up, and I think yes, absolutely. I think what we're having right now is people are nervous because market pricing is not normal. People are wondering whether the prices of stocks reflect real supply and demand, and that uncertainty itself is having a threat to liquidity. And I think until this is cleared out, the rational investor is going to hang back and wait to see what is behind all the smoke.
Clint?
Yeah, I mean, I really don't think there's much of an impact to liquidity, I'll say at the macro level. As long as we've got stimulus coming from the Fed, stimulus coming from the government. I mean, the liquidity that you've seen bolster the markets overall here, that's not going away anytime soon. So, at the highest level, I don't think there's an issue with liquidity right now. But at the micro level, when you start getting into some of these specific stocks where brokers have taken actions to limit trading because of volatility, yeah, absolutely, you're seeing liquidity in certain names, but I don't know that I think it's a market-wide phenomenon at this point.
All right. And, it's difficult to say, of course, because nothing like this has really happened before. Nobody was prepared for it, which is kind of interesting because we have sort of seen this rise of the Robinhood trader, the individual investor over the last year or so. So just what do you think the chances are that the SEC or Congress would put in new rules to counter this from happening again? And what do you think they might look like? I know it's tough to say.
Well, Congress will probably hold hearings and make lots of noises, but they'll probably won't do anything. A, because they rarely do, and B, because it's not clear what role Congress can play other than to ask the SEC, which it created, to do something about it. And my guess is that what the SEC will do is to try to formalize the mechanism that led Robinhood to suspend trading in GME and AMC and others, which is basically to say, look, when you have trading positions through your brokerage that get extreme relative to some measure of what is considered normal, then you have to progressively increase margin requirements on your users, the people who are using your app. So instead of shutting down trading, it's like video game where the more you, like, for example, the more options you buy, out of the money, short dated GameStop options, the more collateral you have to put up as an investor. And that would kind of, be an automatic break. So it's kind of like halting trading, but it does it in a more finely grained manner. That's my guess, but it's purely speculative. But definitely something will happen. And what they'll try to do is do it in a way that leads to the least disruption to trading, but actually pinpoints the problem, which is this flood into positions without any rationality.
Clinton, how do you see the SEC responding to this?
I go back to what I said earlier about market structure. I think the first thing you need to address is the conditions that were in place to allow, a relatively small number of investors with a limited amount of capital to be able to drive that kind of price action. I was looking at Apple this morning. Apple trades $14.5 billion a day in volume. You're not going to be able to have that kind of an impact in a stock like Apple, but there were conditions in place that allowed GameStop to have the move that it's had. And you've seen it with several other stocks, right? It's not just GameStop. And one of the things they all have in common is a high short interest. So I think, one of the things that regulators will probably look at is, do they need to change some of the rules around how much of a float can be sold short, and starting at that level to address it. And I can guarantee you right now, I think you're already seeing some of that happen behind the scenes in the industry as well. You're seeing hedge funds, other asset managers tweaking, whether it's their risk management process or their algorithm for shorting a stock. They're going in and they're looking at what stocks have a high percentage short interest, and they're staying away from those, or they're covering their positions in a way. I think in the near term, that'll kind of take care of itself through those mechanisms.
All right. So now, of course, the $1 million question. What is the average investor to do about all this? Should we go chasing after these beaten down stocks that are shorted? Should we prepare ourselves for more volatility? What's the best way to do that, Clint?
Well, if you're taking the you only live once mentality toward trading, please, by all means, have an exit plan, have an exit strategy. If you're riding these big gains, know when to get out. And I'll give an example of, if I'm in a stock and we're seeing rapid, price movement in the short term, one of the things I like to do is to use moving averages as a stop or as a point to at least take some profits on a name. And I'll show you a chart of Bed Bath Beyond. It's been one of the stocks caught up in a lot of this. And I've got a couple different short-term moving averages on here. You see the word EMA and then you see SMA. EMA means exponential moving average. SMA means a simple moving average. And I'll get to those in just a second, but you can see, if you use something like a 9-period moving average, that's going to track very closely to price, especially when you get these quick uptrends. You can use something like this, and if you see a close below that 9-period EMA, maybe you at least want to take profits. And then if you continue to trade lower and you take out the 20-day, then you're out of the position completely. Just having an exit plan like that in place. And then the distinction I want to make between these moving averages is just to know what tools are available to you, because a simple moving average just equally weights all the prices and the period that you're looking back to. But on the exponential, it gives more weight to recent price, so it responds quicker. And so that's why I'm showing the comparison on here between the 20 EMA and the 20 SMA. It's still, both of them are 20-period moving average. You can see the purple line catching up to price quicker. So that just allows you, if you're going to use something like this as a stop, to keep that closer. And then you also look at the momentum in these stocks. So that's what the MACD indicator is at the bottom panel of this chart. That's just a way to gauge when momentum's getting extended. I circled that in one period back here that saw the dip in the share price. So when you start seeing momentum get extended like this, potential for mean reversion, maybe that's something you use to at least, once again, take profits on a name if you've seen big gains there as well.
All right, Ted, let me ask you, GameStop, still a buy?
Well, I don't know if it's still a buy, but I think, just following from what Clint was saying, in the bigger picture is that if you're going to buy any stock like GameStop, you have to have, or GameStop, you have to have a theory of who you're going to sell it to get out. And I think that's the problem, that a lot of people don't think that way. They don't think like, who am I going to sell this stock to? Who's going to have an incentive to buy it at the price where it is right now at the top? There are many different ways. I mean, the GameStop thing is based on the idea that that short sellers are going to be forced to buy stock from you, and that's your end game. But that's not always the case. I mean, sometimes it doesn't work well. And if everybody thinks that they're going to sell it to everybody else, and everybody's thinking that all at once, then definitely you've got a problem. So I think you have to have a theory of who will want to buy this stock at this price. This is an unusual situation. And in most cases, that's not the case. So when a stock goes up like this, chances are you're going to run out of buyers and the price is going to go back down again. And so you just have to pay attention to what Clint just said. Even if a stock is still rising, you've got to sell it, because eventually it's going to get to the point where nobody's going to buy it from you, and you're going to lose your money.
All right. Any closing thoughts, Ted?
Well, people talk about things like, the function of the stock market. They say, it's to enable price discovery or to encourage capital formation, to let, companies raise money. But the basic theory behind the whole GameStop thing is that it's fun. It's fun to mess with Wall Street. And that's not what the stock market is supposed to be for. But the current structure of the market, the current situation with the internet, it allows it to be like that. And I think it's important to recognize that this is not going to go away immediately, because things have changed since the rules were written. It's transparently clear that the stock market is not primarily about capital formation at the moment in the United States. In fact, more money is liquidated by companies through stocks than is actually raised through stocks. So it is basically a casino. And the problem is that we have such massive problems in the United States today that need to be addressed, that this just reveals how, in a sense, out of touch we've become as a nation and also as a financial system with our priorities. It's like, Nero fiddling while Rome burns. I mean, this is kind of an example of what happens to societies when, they're on the verge of a crisis, that something crazy like this happens. It's almost like Hunger Games or something. Mm-hmm. But hopefully that will bring people's attention back to what's important, which is what the stock market is meant to do. Whether that happens is anybody's guess. But I think it's going to take a while for people to realize. It may take another crash for us to realize that these kind of things indicate tipping points.
All right. And then final word from me, the best thing you can do right now to protect yourself is to check out that presentation that Ted gave just a couple days ago. So make sure you click the link and make sure you tune in next week for our next edition of Your Money Matters. Thank you so much for watching.